Hello class. In chapter 3 we discussed the adjustments on a prior video. So the rest of chapter 3 we're going to cover closing entries. The accounting cycle starts with what you learned in chapter 2, how to record transactions, and then it moves to adjustments for things at the end of the period, and then financial statements, which you learned in chapter 1. All of this culminates at the end of an accounting period, which is either a month, a quarter, or a year. And at the end of that month, quarter, or year, we close out our temporary accounts. So closing entries help us chunk our data into certain periods of time. Just like a sports player, if you were analyzing their stats, maybe how many touchdowns the quarterback threw for a season. For the 2015 season, they might throw 20 touchdowns. And then at the end of that season, that record is put into that athlete's career record. And those 20 touchdowns don't magically disappear. We just reset the new season so we can analyze the data. Then in 2016, the quarterback only throws 10 touchdowns. We say, what was the issue? Why? Maybe there were some people that weren't blocking correctly to protect the quarterback. We do this with all kinds of data. You do it with your GPA. You say, for this semester, my goal is to get a 4.0. And if you do, great. That gets dumped into your GPA. If your current GPA is 3.75, then that semester you increased it once you dumped that semester's 4.0 into your GPA. And then you get a reset and you start the next semester over, and we analyze the data. So that's what this chapter is about. Closing entries make your temporary account balances go to zero. There are certain restrictions because we don't close every account. We only close temporary accounts. We reset them for the new period, for the new month, quarter, or year. So the first point in learning closing is to ask yourself, which accounts do I want to close out? I want you to memorize this through the creation of financial statements. So you are going to close out any income statement accounts. You'll close out what I often refer to as red accounts, because we will close revenue, expenses, which are both on the income statement, and we will close out dividends. Those are our three temporaries. We do not close unearned or deferred revenue. That's a liability. Do not close deferred revenue. Do not close deferred revenue. So once you have decided which accounts need to be closed, you've learned that process, that red accounts, we're going to close the income statement accounts. We're going to close dividends also. Into what account? Well, we put it into a permanent account. We put it into our retained earnings, just like that career record, just like your GPA, just like if you had a car and you were analyzing how much gas mileage you got for a certain trip. Once that trip is over, you reset it and you start a new trip starting at zero, but your odometer on your car never stops. So temporary accounts, revenues, expenses, and dividends, I'm going to often refer to those as our red accounts, are the ones that get closed. And where do they get closed into? You actually already know this. So inside my equity box, I have our two permanent equity accounts. Another box inside the box. So we have a box of retained earnings, and we have a box of common stock. See if you can see that with the reflection of the light. Inside common stock would just be any issued additional stock. Inside the retained earnings account, though, we're going to find our three temporaries. We're going to find our revenues. We're going to find our expenses, and you've actually already been doing this when you learned how to create the financial statements. You just didn't know that's what this was called. And you're going to find the dividends. So these are the three accounts we're going to close. The next thing you need to remember is their normal balances. So once you have decided, I know the three accounts that are the types of accounts I want to close, you will then have to do the formal process of creating those closing entries. So next you need to know their normal balances. Normal balances of revenues would be a credit. It increases with a credit. This has a normal credit balance. I'm going to erase this. So the normal balance is a credit. It's a positive functioning account to equity. The normal balance of expenses is a debit, and the normal balance of dividends is also a debit. So think of it like a T account. If there was anything in those accounts, the revenues would be on the right side, and the expenses, revenues would have a balance on the right side, let's say $10,000, and the expenses and the dividends would have a balance on the left side, on the debit account side. So we'll just put an expense T account, and when you close them, if you had $7,000 of expenses, you want to make that T account zero out. So in order to close out revenues, if I want its balance to now say zero, I'm going to have to debit revenue. I'm going to have to do the opposite of its normal. I need to know its normal balance, and then I will do the opposite of the normal on the closing. So I will debit revenue, but I can't just debit one account and say the entry is completed. So I will debit revenues, and I will think about the box that it came out of on that analogy just now, or the career record, and I will put that credited $10,000 into retained earnings. It is a permanent account. The only ones that are temporary are your red accounts, your revenues, expenses, and dividends. So there was a credit balance in revenue. I want to close it, so I will debit the revenue and I will credit retained earnings. Expenses work the same way. If you want to close the expense account, you would do the opposite of its normal. You would move that normal debit balance down into retained earnings. So now you can see the balance of retained earnings is the difference between those two, $3,000, which would also be your net income. If you had first started and there was nothing in retained earnings, then your net income for the year would be the amount that got added to retained earnings and would create its balance. So again, on closing, we need to know which accounts are temporary, your red accounts, revenue, expense, and dividends. We need to know their normal balance, and then we will do the opposite of their normal on the entry to close it into retained earnings. So that's it for closing. If you have questions, please contact me through email. Thank you.